welcome everybody. And today marks the final AI Circle of 2021. I am your host, Aaron Yoon. I'm the product manager here at iFlip, and we're so excited for all of you to join us today, especially after the slight schedule change we had. We canceled the session from 2 weeks ago, and this is, right in the middle of the holidays. So I can't say enough how much I appreciate you all joining us during your holiday week here and carving out some time to hang out with us and recap the year. Today, again, is our final AI Circle of the year. So we are going to look ahead to 2022 here, as you can see on our screen. We're going to recap 2021. It was kind of a confusing year, and we'll get to what we mean by that in just a moment. And for those of you that are also looking forward to the Crypto Masterclass that's happening, we do have some updates and on the launch of the crypto platform and the launch of the Crypto Masterclass scheduled to start in mid-January. And of course, at the end of the session, we'll finish up with a little Q&A. So a little bit of a light load today. I don't imagine us going as long as we usually do. But before we get to any of that stuff, we have to get through our disclaimer. So please bear with me as I go through our disclaimer here. iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip smartfolios that you select are suitable for your investment profile before trading in a live brokerage account. With that out of the way, I'm going to turn the mic over to none other than our esteemed CIO, Kelly Korshak. And really, Kelly, I have just one question, and I think that it's the underlying theme of the year for a lot of us, both customers and all users of the platform. The S&P looks like it's going to finish about 28% for the year, which is a crazy number. On the other hand, our iFlip smartfolio that trades the S&P exclusively, the SP 500 smartfolio, looks like it's going to underperform and finish at about 18%-ish. If the week ends, the year is going to end in about a couple of days. And it looks like we're on track to finish about 10 percentage points below the spider. So, I mean, the numbers don't lie. We're underperforming this year. Can you explain what's going on this year?
Hello, Aaron. Hello, everybody, and Happy New Year. I hope your Christmas was good. Yeah, Aaron, thank you for asking that question, because if you didn't ask it, I would have brought it up anyway as first thing. As everybody that belongs in the Flip community knows, our job and our number one purpose that Flip exists for is to offer its clients the potential to outperform the S&P. And the way it does that is by trying to minimize risk. So you try to minimize risk as the market advances, and you try to take advantage of value when the market declines. And by the way, you don't want to even try to be in the market while it's declining. Otherwise, you have no opportunity to find value. This year, unlike the previous 3 years where we outperformed the S&P 500, we seriously underperformed the S&P 500 on our main model. Right off the bat, it's hard for people to hear this, but there's nothing to be concerned about. Markets ebb and flow. This market, I'll try to put up an S&P 500 graph. But this market in 2021 was probably the most consistently bought market I have seen since the late 90s. prior to the 2000 tech bubble, under the Clinton administration. And again, I'll just speak fundamentally first and then go algorithmically to try to explain our underperformance for the year, because it needs to be talked about. It is not something we can hide under a mattress from. The bottom line is we underperformed this year, and that means users, many users, and I would say most users on our platform underperformed for the first time since inception of Flip. Fundamentally, the way the market moves up or down is generally with a certain amount of volatility. And right now, believe it or not, we are at historic low volatility, not high. A lot of people think because the market will move around 1.5%, that seems very volatile. It's 1.5% is what we aim for. 1%, 1.5% is a big move. But believe it or not, we really haven't had a lot of those. The market is actually had less volatility this year on a day-by-day basis than it has in the previous 3 years, which is not really that surprising. What we notice is at these higher levels, nominally though, the market moves more, right? So for 5 years ago, for example, the S&P moves 1%, but the S&P is priced at 2,000, for example. Well, 1% move on price of 2,000 is 20 points. Well, now a 1% move in the S&P 500 is around 47 points. So your account feels it more because nominally the market is moving more, but percentage-wise, it is not. It's actually lower volatility, and you can see that in the VIX. And if anybody watches the VIX, you'll see that the VIX has actually been at historic lows. And the VIX is the anticipation as measured by options over the next 30 days of the volatility of the market. So when we see the markets moving around these days, don't mistake the nominal move for the percentage move. It's been low vol. In a low vol environment, fundamentally what's happening is the market and its participants are complacent. And when people are complacent, it means that they have literally no fear that the market will go down. They actually believe that every dip can be bought. And to their credit, every dip could be bought. And the testimony to that is we're at all-time highs, or maybe a fraction off of it as of right now. And so when you see a market at all-time highs, that kind of tells you volatility must have been low. And it also tells you that if you bought any dip, you would have done well, because there is no higher price than where we are now. So those combinations fundamentally is what allowed the market to kind of move higher. And then beyond those psychological reasons, the fundamental reasons are very clear. Between last year, when there was the injection of funds under the Trump administration, was that last year, 2020? Wow. Since Trump and Biden, approximately $6.5 trillion have come into the economy over a period of less than 2 years, around 19 months or so. And when you add $6.5 trillion to an economy, even if it all hasn't been spent, that money is still earmarked to go into people's pockets one way or another in the coming years. There's the liquidity that drives the market up. There's the reason the dips have been bought right there. And that is, so as a fundamental trader, you can say, hey, where else am I going to put my money? There's so much money out there that there's, what else can I buy? Who wants bonds? What can I get out of a bond? That seems very risky. So the money has nowhere else to go. So at one place, the main argument has been, that's why the market goes up. And I think there's a lot of truth to that. There's no doubt. So fundamentally, we have, that's the backdrop. The other thing that's going on, and that's just the fiscal side. That's what the federal government and Congress are now mandate through reconciliation. The president and or Congress can put money in. The other side of that coin is the Federal Reserve, which of course has maintained a very open policy. Yes, they are starting to scale back bond purchases, but look at the words, scale back. It doesn't mean they've stopped bond purchases. They've just scaled them back. Bond purchases mean the federal government can take all bonds away from people that own them and say, here's the cash for the bond, and I'm going to now hold the bond in my inventory, which means that's a way the Federal Reserve can put money into the system by buying back the bonds that they've already issued to US and foreign citizens. So that's the other form of cash that's come into the system. Interest rates, as important as they are kind of meaningless here, because there's a lot of ways for the Federal Reserve to inject cash into the system to create an environment of business where money is cheap. In fact, so they've made it so cheap that it's caused inflation. And so that's what we're going out at the end of the year. And that, by the way, is in the short run is another reason fundamentally why the market, S&P 500 in particular, will advance and take, of course, all its stocks with it. So there's the reason why the market's gone up. Fiscal reasons, central bank reasons. This is no longer COVID. This is just money in the system sloshing around. And that's, by the way, all without the triple P, which would have added yet more cash, Build Back Better, if that's what people want to call it. Even more cash would have been added to the economy if that was passed. That didn't pass, but look, the market's still at all-time highs. And after it didn't pass, look what happened. One day sell-off and then a 5% run after the triple B was rejected. So
Right.
there it is. So there's the fundamental reason why the market's higher.
Got it.
Why did we underperform?
Yes, I was gonna go there. If the dips, if the general sentiment in the market is that dips can be bought, why didn't our AI do a better job of buying those dips? I guess is the real question.
It bought a few, but not enough to make up for the many times that it was out of the market waiting for a dip, that it couldn't get. The dips became more shallow. In other words, instead of a 5% dip, we'd get a 2% dip, and people thought that was the bargain. So fundamentally, in order to protect for the downside, there's only two ways to do it. One, you got to be out of the market when the market goes down, pretty obvious. Or two, you could buy puts in the market and take a small fraction of your portfolio, buy some out of the money puts. So in case the market has some serious correction, then even if you're in the market, okay, you lose money on your stocks, but you make money on your puts. However, Flip doesn't use that strategy because right now Flip doesn't employ puts. The other thing we could do is sell premiums, sell calls. But again, for the same reasons, Flip doesn't do that yet. It is something on the horizon that we will do. But right now, because the dips have been so shallow, we've been out of the market way too much this year, given the fact that the market with a low volatility had very shallow dips. So the combination of these shallow dips and the strong fundamentals coupled with low volatility is why we underperformed. So if you look in the 3 years prior where Flip outperformed, you'll see those dips were more serious. We had a 30% dip last year for the COVID. The year before, 2018, I remember the end of that. It was a 20% dip in 3 weeks, right before Christmas. We had another dip a little bit earlier in the year we did catch, but I mean, we caught that one with our teeth. It was just enough for us to buy, and we rode some of that up, but then we got out, and then the market continued to rally. So that's the reason we underperformed. And by the way, that's to be expected over time. In order for us to manage risk, we're going to have to be out of the market and in cash. And that's exactly what happened this year. We were in cash way more than we should have been. And in retrospect, does it tell me we should change the model? No, the models are fine. This is how they behave. And there will always be years where there's underperformance when a market is on a steamroller on the upside. If it's on a steamroller on the downside, we're not going to be in it. So we never have to really worry about that. What we do have to worry about is the steamroller that we saw. There's a chart over to my right. So if you see me looking, that's what it is. The steamroller that we saw, that was the S&P 500 this year. So that being said, let me talk about next year. Because after all, it's a marathon in investing, not a sprint. 2022, let me just fall back a second. I personally felt that the market is extremely overbought, especially as we moved into the third quarter of this year. And I was nervous about the market during September, October. It proved to be moot. The market went down in September, but it was up in October. So as if nothing happened. And then of course, November, December, especially December, looked good. And I was nervous personally, my own opinion, that the market does not feel right up here currently at all. It feels wrong. And there's a lot of reasons I can point to, and I still will point to, and this goes to 2022, everybody. There's a few things to note. Most IPOs that came out in 2021 are underwater. Over 2/3 of them are underwater. So that means that cash is chasing any new stock. And if they come out at 20, 67% of them have prices that are lower than 20, than where they got offered. That's not a good sign. That's telling you people are willing to buy crap because they think it's just going to go up like anything else. That tells you there's an exuberance in the market. Another one is the market is being led by a very small handful of stocks. And those small handful of stocks are wearing thin. Most of them, believe it or not, are not even at new highs. So look at the FANG stocks and you'll see that many of them are nowhere near new highs. So they're not really advancing anymore outside of Google. And if you look at another statistic that I like to look at, the overall number of stocks below their 50-day moving average is enormous. It's much more than 50%. I heard saw 58%. It tells you that right now we're kind of entering what I think is the end of a super cycle bull market. Now, given the backdrop of all the money and the inflation is going to be good for stocks. Given that backdrop, what do? It's like, well, the one backdrop says fundamentally I should buy stocks, but yet there's all these internals that are telling you to be out of stocks. Well, this is exactly where the algorithms come in. So they did underperform last year. I've never seen back-to-back years of underperformance in this particular S&P model. That's why we follow it so much. And it impacts every other stock we own. So if you own other stocks, even if they're not on the S&P 500 benchmark, it will be impacted by the S&P 500 benchmark because we really care about the overall market. So I expect 2022 to be very choppy, more volatility in 2022 than we saw in 2021. I expect inflation to remain and probably become worse through at least the first 2 quarters of 2022. That tells me if inflation is worse, I think the fears of inflation will create higher volatility than we've seen in 2021, which means that the models will find their opportunities to buy more serious dips to find value. I feel another thing that I'm noting about the models as well is the type of signals that they're giving is they're trying to be out of this market. So we are out of the market right now. I'm actually very comfortable with that position personally, for whatever that's worth. I've been wrong this year, folks. But I do think that 2022 is not going to be the year that 2020 or 2021 was. I think 2022 is going to be a more dangerous environment. And that's exactly when we need to hold and follow our rules that are embedded inside of the AI, which missed it this year, and the algorithmic ideas that are also feeding the AI. We have to stick to our guns to be able to follow these procedures and formulas forward. As soon as you try to cherry pick and say, oh, I'm going to chase something, I'll just hold it now and not use an algorithm, is exactly when people get hurt. So here, more than ever, do you need to hold and maintain rules. So I expect, putting politics aside, an increase in inflation over the next 6 months at least, possibly through the end of the year. I expect more capital possibly coming in with some kind of reduced BBB being passed in some way. However, I also see quite a bit of danger politically, as when you see possibly that the Republican Party seems to be able to have a little more clout. You know, they will force the brakes on this economy at some point when they're gathering momentum, where they will force either replace Powell as the chairman, to put someone in there more to their liking, who will be hawkish on interest rates. Higher interest rates immediately will cut off 2 things. 1, the feeding mechanism to the stock market, and 2, obviously that's going to be coupled with higher rates. The Fed has predicted that higher rates will not even occur until 2023. Respectively, I feel this man is wrong. I remember back in 1980, I was very young, but I still remember they predicted the exact same things from the Fed chairman that was right before Paul Volcker. Paul Volcker came in and moved interest rates from 4 to 10 overnight. 6 points. Market plummeted. Everybody hated him because he raised interest rates, choked off the economy, but he also choked off inflation. And inflation is a problem that people have yet to see. The generation that's witnessing me right now speaking, Aaron here and Lee, if you can see them, they haven't sensed and ever experienced inflation. And when you do, you'll know it, and you can start to feel it now, I'm sure, in little ways. But when you see it in its full monstrous way, you'll see that anything becomes more difficult. Buying a house becomes more difficult. Buying a car becomes more difficult. You're forced to reuse things in a way where you normally replace them. It puts you almost in a wartime footing. And this is what I do expect to occur, because most administrations realize the deadliness of this. And this is occurring worldwide. And remember this, folks, in Europe, the mandate for the central bank is to just manage inflation, because Europe has faced inflation in much deeper ways than America ever has. America has the dual mandate of low employment, full employment, and inflation. So I expect it to be a choppy year. I expect the algorithms to outperform next year and recover much of what they lost by the end of 2023. So I actually would encourage people, especially now, especially after such a dismal year, is think of it as returning a reversion to the mean. The mean is that the model generally beats the market. This year, it got its butt kicked by the market. I expect next year, maybe a small butt kicking at least on the behalf of the models over the market. So there's where I am on all of that. So, which is a big mouthful, everybody. And if you bear out with Flip, because it will work, it always has. And I think it will continue to do so. I'll now move over to a couple other little subjects I think are also very important, which is the other portfolios. Remember, it's not just the benchmark and underperforming that. It was all kinds of things kind of coming together this year to cause underperformance, where I see some of the other portfolios actually having very good years coming up. For example, SPY. I also see various things in some of the other portfolios that will be completely remodified early in the beginning of January. For example, the moderate plus will change around a great deal. That was a serious underperformer this year and a real disappointment to me. However, some of the other models, like the SPY Plus, was still able to hang in there and do well. Why? Because of the Apple component being, again, close to all-time highs. So some of these micro portfolios are still good, even though they've been damaged over the last 3 months. But I think those are things to stick with. I think there's going to be a whole new tranche of new portfolios somewhere in the first quarter of next year that you will see some, like a Bitcoin portfolio, of course, is coming out. We're going to have, again, we're making the right strides, I feel, in adding Bitcoin is a larger component to some of these equity portfolios as well. And also look for some restructuring of certain portfolios, again, conservative, moderate plus. They will be modified, but that's the model has already told me what they're going to be modified to. So I already kind of see that. The 4Q rotation, of course, will again modify. We will find out what the new one of that is in the first week of January as well. I expect Flip to recover much of the missed performance of 2021 in 2022. And I think, again, for all of what it's worth, I look back historically on this, and I'll just say in summary to everyone that we're never going to beat the market in all years, but we will always beat the market in a down year. And what we've seen over the last 3 years is very good performance because of our ability to buy dips in the years prior to 2021. 2021 was the disappointment because the dips weren't there. I mean, I guess unless you call a 4% dip a dip, or a 3% dip, or a 2% dip a dip. I don't. I think a dip is more like 6 or 7% personally. And by the way, historically, volatility-wise, that is the normal dip. Even though that's managed, it just couldn't be overcome this year with 2% dips. So it was a remarkable year. I think 2022 will not be as remarkable on the upside as 2021 was. I do expect the market to probably advance, though, again, because of all of the momentum and capital that is still floating around out there. But look for higher volatility and larger dips, which bode well for our models. So I think that's a good summary of me talking for about 20 odd minutes, nonstop. If there's any questions out there, I'll do my best.
Yeah, well, yeah, folks, if you have any questions, please feel free to put them in the chat, or I prefer that you put it in the question and answer box, but either one will work. We'll let some of the participants type in their questions if there are any. But I will also chime in and add this one little bit. As a trader, I use iFlip myself to manage the more longer term investments, but I'm also a trader as well. And I have to say, although everyone is looking at the S&P as like the barometer, right? The measuring stick to measure our own performance against, and the S&P has been doing phenomenal this year. Most traders who are active, if you're here, I consider you active, right? And you're not just plugging money into an index fund and just turning a blind eye to it. You're actively participating in webinars like this. If you're active, you're probably not buying and holding the S&P, which is probably the only way that you are going to get that 28% return this year. You are probably, and this is whether you're a stock trader, futures trader, options trader, forex trader, whatever, you're probably making moves, trying to manually beat the market yourself. I do that. I think we all do that. Kelly does that. And it's been real tough. So it's not anybody's fault. This happens sometimes. The market, this is the nature of the market. And if you're a manual trader out there and you took a beating this year, especially maybe you're profitable, but you're not as profitable as a S&P that did 28% for the year, and you're feeling like kind of down on yourself, don't worry about it, right? It's not just you. Most traders that are active probably did not beat the S&P this year, probably. They probably don't beat the S&P most years, statistically speaking, but just wanted to put that out there in case people were feeling bad about how their accounts were finishing at the end of the year.
And let me also chime in to everybody out there. You're right, Aaron. I mean, there's going to be people this year that had some spectacular year in the markets because it lent themselves to that. But at the end of the day, to everyone out there, I'm eating some, and so of our algorithms, a big chunk of humble pie. And it doesn't taste good because it's so easy to come on and talk about the models or even my thoughts when we're accurate and when we're making money. It's so much easier to talk and it creates enthusiasm. But periodically, there's just no denying that it's at the end of the year. There's no way we're going to pull out tomorrow a rabbit out of the hat to beat the market. I would have said that 2 weeks ago. By the way, I'm sorry for missing 2 weeks ago, everyone. I did have a family emergency. I want to let everybody know I don't ever want to miss my AI circles. I was planning on eating the pie at that time, but I have to save the yumminess for the very end of the year when the market is, of course, at all-time highs. I have nothing I can point to say, see this or see that. No, it's called humble pie. It tastes bad, but we're here, and I doubt very seriously I'll have to eat this pie beyond the first or second quarter of next year. And I think we'll start to see the reason why we all came to this platform in the first place, whether as an experiment or as a belief or as an organization, whatever it may be. We will never shy away from our failures or our misthoughts, as well as we will try to be humble when our models are doing well within the market. So it's just an ebb and flow. This is a procedure. These are things done mathematically. And this year, the math didn't manage the market. But I will tell you, over time, the math will always outmanage it. And so it's just time. And I'm not asking people to wait till they die. This is just time. Generally, a year like this is followed by a very good year subsequently, model-wise. So my hope is the market goes up 10% and we're up 20. Mm-hmm. That would be a great thing. I'd hate to see it the other way around, but where the market goes down 20 and we're only down 5 or 7, because either way, I still want the market to go up because it hurts people when it goes down. And nobody is really happy in the market if, oh, maybe you lost less with flip, or you made a little with flip, but you didn't lose that much because of something else. At the end of the day, we just want the market to kind of rise with some kind of order. And generally that's what the market does. It just, this year, it wasn't that way. It wasn't to be. So let's see what happens next year. I have confidence that these models always rebound, and I remain confident that it'll also rebound next year as well.
We do have one question here, Kelly. I think it's an inflation-related question, so I think it's right, on track with our talking points. Kimberly Hart asks, my CPA told me I am losing 6% on my cash and I should invest as much of it as I can. Thoughts?
You're losing 6% on your cash.
That's what she wrote. Yes. I'm assuming that I'm assuming she's referring, or the CPA is referring to, the buying power of the cash is diminishing because of inflation.
Okay. If you have cash right now and the market's inflating, on a technical level, your accountant is correct. In an inflationary market where all assets are going up, any cash is something you don't want, right? You want to own some asset that appreciates. Cash doesn't appreciate. You put it in the bank, you put it in the mattress, that dollar is still a dollar over a year's time. And so, but he's wrong in another sense. Inflation is a very good thing if you have an asset up until the time when they decide to kill inflation, in which case your asset will lose literally overnight a huge amount of its value. So remember the housing crisis, everybody? If you're right there, the 2000, it started in the summer of 2000, all housing was going up, and housing was inflating. In particular, housing was inflating. The market wasn't really inflating. There was no real inflation at that time. But people overnight lost 30, 40, 50%. I live in Arizona. The market was down 50% in a year's time. I'd rather have had cash. I think that if you have a certain amount of spare cash right now, and you want to put it into the market, you got to bet that inflation is going to still be here. Now, I just mentioned it's going to be here at least another 6 months. So that's, your accountant is correct in that sense. But if we have opportunity on the downside, anytime, for example, in the first quarter, I sure like to be able to take advantage of that inflationary thought at cheaper prices in the market than where we are now. I can tell you right now, the market is extremely overbought. 5% runs in 5 days are to be sold, not bought. So where is that dip again? Maybe is it 2%? I don't know. But I can tell you that regardless of your accountant, I still feel having some cash here at least, and maybe even a great deal, is not a bad bet, because markets still can go down. They can still go down, and unless maybe you want to buy some gold or you want to buy some diamonds or something else. I don't really feel that I would just own an asset because of inflation. So in that sense, I would argue with the accountant.
Thanks, Kelly. Yeah, absolutely. It goes both ways, right? I think the question phrased by Kimberly says it's just looking at one side of the coin, but investing inherently involves risk, which means you could lose more than you would have ever lost through inflation. So that's one of the reasons we have platforms like iFlip to help the average retail investor manage their risk without having to become a professional level trader / investor like Kelly is, right? We did have before. If you have any other questions, you can feel free to continue to submit them. But before we do, I just want to provide some of the product side updates and some of the crypto updates, because I know that that's what a lot of you are here for. So let me share my screen here. And I will, wait, which monitor am I sharing? think it's this one. Okay. So we do have the Crypto Masterclass start date. We do. A lot of people have been asking when is it starting? When is it starting? We do have the official start date. It is January 11th, 2022, which is a Tuesday. Should have probably written that there. It's a Tuesday at the same time as you're used to with the AI circles, 4 p.m. Pacific, 7 p.m. Eastern. They are Tuesday and Thursday live sessions. So it will be a Zoom similar to the AI circle that you can log into. And it'll be interactive. It'll be structured very similar to what you're seeing right now, with panelists, and we'll bring you on for questions when it's applicable. However, we are also creating a Facebook group where you can engage with questions after the fact, and that's where you'll be able to find the replays. We did think about, we contemplated what platform was the best fit for something like this, and we figured Facebook may not be everyone's favorite, but it's definitely the most universally familiar. So we are starting with our Facebook group. We may evolve into other platforms later on, but for now, Facebook is the place where you will find the replays. And if you want to engage by asking questions, let's say you have a session on Tuesday and it's Wednesday and you're thinking about the class that you had the night before, and you have a question, how do you engage, right? The Facebook group is the place to do that. Now, this is a invite-only paid masterclass. Some people have gotten a special deal because of the holiday promotions. Some people are early buyers, which is probably even a better deal. But depending on which package you bought, if you have the Crypto Masterclass and the consequent upgrade to your platform, you do want to, let me just show you right now. You want to find our Crypto Masterclass group. It's a private group, and request to join it, and provide the email address that you've registered and bought the class under, right? Your Facebook email address may not be the same email address under which you purchased this class, this package, right? So it's possible. So the way you do that is, let me just get out of here. This is the group. Oh, I see somebody has already asked to join. I will paste this link into the chat here. And I see we have a bunch of questions about the crypto class already. I'll get to that, I promise, before we break here. So that's the link to the Facebook group. And just request to join, and you will be asked right away to provide the email address that you registered the class with, not your Facebook email address. I can't stress that enough. You're going to cause a lot of confusion for both Lee and I if you just give us your Facebook email address, and we'll have to follow up with you, okay? Because this is a private group. It'll be a small. The only people that are in the group that you're going to be engaging with are people that are also registered for the class. This isn't open to the public, okay?
Hey, Aaron, you actually sent the link to the host.
Yeah, I realized. I only sent it to us, not to everybody. Sorry. Here's the link. Sorry, guys. I sent it to everybody. You should see it there. Now, a couple of questions about the crypto class. How long are the sessions? Approximately an hour. The sessions will be taught by, I'll be teaching a couple of them that relate to more of the trading and money aspect of things. And we're bringing in a crypto expert. His name is Jawad. He has a master's degree in cryptography and all of the technical stuff that is just way over my head about, like the technology that underlies crypto. Crypto is more about the evolution of technology than it is about the evolution of money. If you really get down to the nuts and bolts of it. So he is an expert that can speak to both ends of it. And his name is Jawad. He is not here today, obviously, but you'll get to meet him because he'll be teaching the majority of this course. And we'll have guest appearances with, Kelly, of course, and Randy as needed, as pertinent to the modules of the course. Sessions are Tuesdays and Thursdays. They're approximately an hour. They may go over depending on how many questions we have at the end. Our dedication to you is that we will not end the session without everyone feeling that their questions, at least at that point in time, have been addressed. Obviously, we have the Facebook group because eventually people are going to come up with more questions, even after the class is over, as you digest the information and stuff. And this is our way. The Facebook group is our way of continued engagement with all of you. Okay. Let's see. What is the name of the group? The link is not showing in the. Okay. Well, the name of the group is iFlip Crypto Masterclass Training. Right. I didn't think that was a tongue twister, but it ended up being a tongue twister. Let's see.
I'm
What are the
already
questions?
confused, Aaron. I'm being honest with you with the Facebook thing. So maybe I'm just too old. I'm going to interject real quick. I can tell everybody out there, Jawad is a very smart guy. He's of the age group that really understands crypto without all the big words and how it works and some of the things that are good in it. I'm looking forward to teaching a few of the classes myself. However, they're presented, whether I'm on Facebook, Meta, what do they call it? It's the metaverse now.
Metaverse. I don't know.
Or if it's a Zoom meeting. I'm just going to vote right now for the Zoom meeting because I like having it just sent to me and I click. And
yes, well, we will actually have that. Actually, one person is actually asking that very same question. So if the class was included with my purchase, I still need to deal with Facebook to register. A link won't automatically be sent to my purchase email. No, of course it will. Of course it will. We will email you the Zoom links similar to the way we email you the AI circle links. Of course, okay. You don't have to join the Facebook group if you don't want to, but inevitably with these types of things, you're either going to miss a class. Most likely you will either miss a class or want to revisit a replay or have a question that you want to ask after the fact. So where do you do those three things?
Good point. I see it now, Aaron. Okay.
You want to do that. We need a place that everybody can do that they're familiar with. And we didn't have the time to build out a whole website for it, and kind of don't need to because Facebook has all that functionality with us for us. It does all of that for us. So it's just for now anyway. At least this is the first version of this class. I did speak with Randy. We do want to teach this class on a regular basis because it's gonna update, right? The material is going to evolve, and we're going to need to update and amend the information in the class. So we do plan on teaching this on a regular basis, and you all have the lifetime access, right, to engage, right? Let's say the second class that happens in like, I don't know when, let's say, June or August or whatever. Let's say that doesn't fit your schedule because you're on vacation or something for the summer. Well, where are you going to get the replays? That's what the Facebook group is for. So you don't have to, but I think it's a nice place for you to have some backup replay and questions and engagement. Okay, but you absolutely don't have to. We will absolutely email you Zoom links via email. Okay, let's see how many sessions. It's going to be 4 weeks, 2 sessions per week for a total of 8 sessions. Most of it is going to be educational, and the last one is going to be like a recap, and it's going to be very you guys have the advantage of joining us for the very first one, so there's a lot of wiggle room for it to be customized to your liking, especially towards the end. The information is just the information, but the way you want to engage with us and absorb and digest that information is still kind of up for grabs. Again, hence the social media Facebook group. Okay. Let's see here. Did I get everything? I feel like I got everything.
I think you did.
I think I did. Awesome. Okay. All right. Well, that concludes the AI Circle, the last AI Circle session for 2021. Have a happy holidays to everybody. Best wishes here from iFlip, and we are looking forward to a much stronger 2022. We're starting off with a bang with the crypto. You heard from Kelly. We have some new smartfolios and some updated smartfolios on the way, so stay tuned for that. We will resume our, I think we're going to actually skip the AI Circle in January. That's the other piece of housekeeping that I forgot, because of just scheduling, right? Because of the crypto class that's happening in January. There will not be a AI Circle. Probably, if we can squeeze it in towards the end of the month, we will. But I'm going to say don't expect one, because of the AI Circle stuff that's going to be taking up a lot of our bandwidth. So excuse us for that. Other than that, we will see you next year. Have a happy new year, everybody.
Hey, everybody, again, happy new year. Thank you for being a Flip subscriber. Thank you so much for attending these AI Circles. There is nothing to do for early January in the markets. We got to let them flow, let the algorithms do their thing, and they will do, I knock on wood, but I don't think we need that. Statistically, they do better. They always come back after a bad year and do better the following year than the market. So that's something to look forward to. And just in the end, again, thank you everybody for your time, your belief, your attendance to these meetings. And again, I feel all of us at Flip are very blessed to have you all as our users and clients. Thank you so much, everybody. Happy New Year.
Thank you again. Good night, everybody.
Bye, everybody.